I could quite happily sit on the fence with this one, but I'm not. I'm going to go all in and say I think it's more important to have the right.
Welcome to the Exponential Investor Podcast. Want to be a better, smarter, more clued up investor? Well, you've come to the right place. We cover the breakthrough investment ideas you don't hear about in the mainstream to keep you on top of the megatrends and opportunities reshaping our world.
Hello and welcome to the Exponential Investor Podcast. I'm Kit Winder and I'm joined as always by Sam Volkering. Sam, how are you doing?
Morning, Kit. Good to be with you again.
Now, Sam, I'm leading this podcast off because I've got a question for you. I would love to know what you think is more important for an investor. Is it stock selection or is it asset allocation?
Oh, that's a good question. You mean allocation to industry?
Yeah, to industry or to sort of what asset it is. So is it, whether you have stocks or bonds, or is it, which exact stock you have, which exact bond you have, whether you have, gold or this specific gold miner? Is it picking the right company within a sector, or is it picking the right sector or the right asset?
I could quite happily sit on the fence with this one, but I'm not. I'm going to go all in and say I think it's more important to have the right stock rather than the right asset or asset class or industry or theme. For me, I think we see some companies, some stocks can act like other assets. You can get stability, relative stability. You can get income. There are bond-like companies that are traded as stocks. If that's sort of what you're looking for, there's obvious risks that come with it, but there are savings account-like stocks out there that do come with an element of blue chipness about them, as much as we don't really love that phrase anymore, and that pay you an income. So I think if you get the right company, regardless of the industry, that's always preferable in my eyes than having the right kind of asset. I mean, ultimately, that does mean that stocks are the right kind of asset too, right? So therefore, in saying that stocks are more important, I am also therefore saying that the asset is also more important, because I'm also saying that stocks are more important. So you see, it's this Mobius circle, really, that just comes around and keeps swinging back on itself. But I think that's my take on it.
Okay, well, I'm going to follow it up with a challenge then to test that thesis. Do you think over the last 10 or 12 years it would have been possible to find a single oil and gas company or banking stock or maybe a sort of dull construction company that outperformed the Nasdaq?
Yeah, I'm sure, without doubt. I mean, the Nasdaq's done very well, but what time horizon are we talking about here?
10 years.
So what's the Nasdaq done over the last 10 years? 4, 5 times?
Yeah, something like that.
Yeah, there are single stocks that have outperformed the Nasdaq.
I suppose I think what I'm getting at is that the challenge for a value investor has been extraordinary in the last 10 years to even keep pace with the rest of the market, and that you could sort of be in a group of 100 growth stocks and you do better than any of the best value investors in the world have all underperformed the simple S&P 500 or the Nasdaq. And in that sense, I guess maybe factor or sort of that in asset allocation in those terms could be considered superior. Or do you think you could still, within that by being an excellent stock picker, you could outperform the index?
I still think everyone can outperform the index. I think the thing is that it depends on what part of the market that you're fishing in, really. I mean, if you're fishing, for companies that are worth more than, 300 billion, you're not really going to outperform, because most of those big companies form, most of the indexes. So the performance of those companies. No, if all you want to ever do is go and buy Apple and Google and Amazon, then you're probably, to be honest, better off with something like an index. Because if you're going to, again, if you're going to diversify a portfolio into a number of stocks, say you're going to diversify into like 10 to 15 stocks, and they're all big, massive, mega cap stocks, what you are effectively buying there is the index. And so if you're going to make riskier calls and maybe say pick one, okay, well then maybe you can outperform it. So it depends. There's a number of factors that come into this, right? It depends on what size companies and what size stocks you're picking, at what stage, are they at? Are they early stage growth company? Are they sort of past? Are they a developmental company that's developing a service or a technology or a platform or something that's sort of gone past the theoretical and the development stage and is now looking at that point of commercialization and bringing in revenues and moving towards profitability? Are they a profitable company that has traditional earnings that they pay out its dividend or reinvest back into the company? Are they in that kind of growth phase? And what's their market cap? Is it can a 50 million quid company go to 500 million? Can a 500 million quid company go to 5 billion? Can a 5 billion one go to 50 billion? You got to ask yourself these kinds of questions, like what's the market size that they can tap into? So there is certainly an element of, I think absolutely you can beat the market by performing by single stock selection and multiple stock selection, typically in the sort of mid to smaller cap regions. But at the same time, that does require a lot of work, and a lot of people don't have a lot of work and a lot of time to put towards it. I mean, that's what we do. That's our job, and that's why people come to listen to us and subscribe to our work. Some people don't want to do that. Some people just want it easy, and some people just want the index, or they want a thematic ETF, which is completely understandable, and you can do very well out of those. But it's a balance of, is very well to an investor 20-30% per year, which by the way is traditionally ridiculous returns. Like if you're getting 20-30% per year on your portfolio, that is smashing it. You can get single stocks that'll do 100, 200, 300% and more, but you'll also probably get some, if you're being a stock picker, that lose. So what you want to ultimately achieve is, if you're going to get into single stock selection like this, right, you've got to understand that you are going to have losses. And so in doing that, you really, while you want to be picking stocks that are doing 1,000%, and they're out there, and there are ones that you and I have both seen that have done that. But at the same time, you're not aiming for an overall portfolio return of 1,000%, because that is, I'm not sure that's ever happened, really, unless someone's just gone all in on one stock in their portfolio. But diversified portfolios are typically not going to do 1,000%. If you can get double digits in sort of the 30, 40, 50% range, you are absolutely killing it. And that's, so I think people need to temper expectations around how they choose single stocks and where they pick them. And at the same time, have some relative perspective on performance as well.
Yeah, I mean, I think Warren Buffett, who's often thought of as one of the greatest investors of the last few decades at least, he's compounded at something like 19% over the last 50 or 60 years. So
He's
you're
a
talking
stock
30,
picker too, by
40.
the way.
He's
He's a stock picker. He's an active stock picker. Like people are like, oh, he's a value investor. I'm like, nah, he's a stock picker.
I would say that I'm not sure about that. I think he's a factor investor
He
to an
buys.
extent.
He
He
buys.
invests in high quality value stocks,
Yeah,
and
but
he
he's
also
ultimately
is he's
picking
he's
stocks.
also become a negotiator. So now what he invests in is, you know, special deals that only he can offer just after the financial crisis, and sort of he has a capital base that can bail out companies at very favourable terms. So that's sort of what's going on now. But going back to the original question, Sam, about individual stocks or individual assets versus the broader class, do you think that there's a single attractively priced bond in the world right now?
I don't know. You're probably more in tune with that than I am. I'll be frank with you. I really don't pay much attention to the bond market. For a start, I find bonds unbelievably boring, and B, unbelievably complex, and I haven't given them great amount of attention, to be honest with you. So I don't know. You tell me.
Yeah, I suppose. Well, the thought is, with inflation coming and the bond market having also had a 40-year bull market, whether it's in the same place as stocks, where there's a lot of overvaluation and whether there's any value to be found. But yes, maybe the most attractively priced ones are the ones that are inflation linked. That would have been my get out answer. But like you, I haven't delved into the depths. It's more about the the yields on the government bonds that I think we find very interesting because of the way that they dictate the stock market. And with, I think, the US government 10-year bond that has a yield that is now approaching 2%, I think, for the first time since sort of the middle of 2019. And that's a number that's always worth watching because the US 10-year is sort of, one of those key barometers that everyone looks at. So I encourage people to look at that one, if nothing else. And that has had a pretty spectacular run, the yield of late, which means people are selling American government bonds in fear of inflation. So I suppose those are the sort of, without looking at the individual bonds, those are the things that I would be looking at.
Do you know what I'd be really interested to find out is that of whoever's listening today or watching us, I'd like to know if anyone has actually invested in bonds ever.
Oh, I'm certain that a lot would have. That would be my guess, because I think
I think the opposite. I think that most of the people that are listening to us right now have never invested in bonds.
perhaps not by themselves, but if you invest in any sort of managed fund, any 60/40 portfolio, any pension fund. So I will be invested in bonds through my pension, which I don't manage myself, and I'm sure if you don't manage your own pension, you will be too. So they're sort of one of those unavoidable things, and I think there's a guy as well called Russell Napier, a strategist and analyst, and one of the things he's talking about is that the bond market's so overvalued, but the debt that needs to be raised to keep this system going, with inflation on the horizon, is so great, and that with inflation, everyone's going to be fleeing away from bonds very naturally, as they've started to do, which is why that sort of US 10-year yield is rising, the same in the UK, the same in Europe. But one thing he's saying is that governments are going to start forcing people to invest in bonds, and that form of what he calls financial repression, because if the market sells government bonds, the yield spikes, the stock market crashes. That's a sort of transmission mechanism that can happen. And he says that, to keep the system going and to keep being able to issue debt, governments will have to force us to buy it. So even if they haven't, they may well be doing so soon against their will.
It's interesting you bring up that the idea of forcing investors into something like bonds as a form of financial repression, because wasn't it just recently as well that the government said that they were looking at mandating investment in ESG funds in people's pensions, so that people had to invest in ESG funds, which would also indicate a form of financial repression, no?
Yes, especially when you consider the quality of some of the ESG funds, and I think that's something we would talk about, and something we're going to be talking about in the months to come. But putting ESG next to a fund label, or putting green next to a fund label, has very little things. In fact, I read, there are tens of trillions of dollars invested in sustainable or ESG funds worldwide. There must be hundreds of funds that have been launched just in America in recent years, but of those, only 12 have got no fossil fuel exposure at all. Only 12. And that shows that you sort of say, we're sustainable, and one of the great lines is we include ESG criteria in our analysis, but including it doesn't mean obeying it. You can include it and then reject it and just carry on investing in coal power companies and oil and gas companies.
That does raise an interesting point, and this is maybe a bigger conversation about funds, right? And so this kind of comes back as well to what we were saying about bonds. Is that I think that most people have probably never invested in bonds, but you're right, they have indirect exposure, possibly through some funds that they've been invested in. And I would hazard a guess to say that the same thing with people that have probably invested in ESG funds, have invested thinking that they're ESG, but don't actually know the indirect exposure they've got to things that maybe aren't ESG. And it brings into question, I think, again, this whole aspect of people taking greater awareness and attention to how they're invested and what they're invested in, because I think that a lot of people are probably invested in funds and they don't really know what they're actually investing in. So to give you a brief example of what I'm talking about, a little while ago, my dad sent me something. So he lives in Australia and he's got a self-managed, he had at the time self-managed pension. And he sent me this thing that his financial advisors at the time had been pushing to him, which was this US property hybrid coupon note, friggin' ridiculously complex thing that effectively invested in New York property and was taking on debt to buy more. Anyway, I wrote back to him. I said, you know what? This is the biggest pile of dog shit I've ever seen in my life. It is complex. These people are just feeding themselves with the fees. You don't really know what you're invested in, and you don't really know if you're even able to get out if it all goes belly up. And he eventually didn't. Well, he didn't invest in it, but he was being pushed pretty hard by his advisors into it. Ultimately, that fund is now in the process of collapsing, and those financial advisors that he was with and isn't, because we told him to leave them, are in administration. But this calls into question, the entire funds management industry, and who are operating these funds, what you're invested in, how they function. Do you understand what they do? Do you understand how they operate? Do you understand what they're invested in, how the fee structures work, what the debt offering is, who gets the commissions from these fees and funds? And I think it brings back to the point, which is why probably a lot of people do come to us and look at the stuff and the work that we do, is that it's important to know that if you're going to be putting your money into a fund, that you know all those things. And a lot of the time people are getting ripped off from that entire industry. And that the best approach to take is smart, individual, self-managed investments. Choose your own stocks, do the research, do the legwork, understand what's on offer. Because you can do it in the market now easier than you ever could before. And there's an increasing lack of need for some of these funds and some of these advisors that effectively scratch each other's backs. So that whole industry, I think, is in the midst of a massive overhaul, or if it isn't, it's about to get overhauled in a big way. And I think that, funnily enough, there's a lot of stock opportunities that come off the back of that entire industry getting upended as well. So I've probably gone on a massive diversion of where we originally came from or started from with all this. But like I say, anyone watching, if you're invested in a fund and you don't really know what it is or what it's doing, you should bloody well find out, and think and see if it's actually doing what it's supposed to be.
Yeah, well, let's end there, Sam, and just reiterate the point that investing blindly in anything is rarely a good idea, and following advice without understanding it is also probably not a very good idea. So just encouraging people to take an interest in their investments, take an interest in their companies, their funds. It's all interesting, and there are brilliant managers and brilliant funds that we look at out there that are good. So it's not all terrible, but there's a lot out there that you have to be careful of, and just being interested and engaged is really all it takes to avoid the worst pitfalls. So Sam, as always, a pleasure talking to you on these podcasts. Hope everyone who's listened has enjoyed it. And we'll be back again next week with another installment of the Exponential Investor podcast.